London AIM-listed First Property Group, a property fund manager and investor with operations in the United Kingdom and Central Europe, has today announced its interim results, which have given a lift to shares to levels not seen in 5 months, as pre-tax profit has risen more than threefold and it's cut its net debt by a third. Well, Ben Habib is founder and chief executive of the company. He joins us now on the line. Ben, good to talk to you. What's been the motor behind these numbers?
Well, we did one very significant deal during the first half where we restructured the debt on a property we own in Gdynia, Poland, taking the level of debt down from 26 million euros down to around 16 million euros. And that boosted profits by about £7 million altogether. And that's been quite a significant contributor to the first half performance. That's really the driver behind that significant increase.
What about the operational side then? How has it been in the first 6 months so far as operations are concerned?
Well, it's a lot better than it was when we announced our prelims. If you cast your mind back to prelims, it was in June. The country still hadn't come out of proper lockdown. We had lots of COVID preventative measures still in place. And I was much more circumspect about the future. And whilst the occupational markets still remain weak, actually the investment markets have come roaring back. And there's a lot of demand for commercial property investments out there. And the trick, if you like, for First Property Group going forward now is going to be to do the best we can in the occupational markets to drive tenants to our properties and to maintain and grow income, but also to take advantage, if you like, of the arbitrage between the weak occupational markets and the strong investment markets. Buying cheaper property that may be partly or entirely vacant, leasing it up and then selling it into these very strong income desirous markets.
In terms of your operational spread, as I said at the top, you're in Central Europe and the UK. Can you give us an idea as to how the two regions are working independently of each other? Are you getting a better idea as to the future and the outlook here in the UK? We're well vaccinated over here. We've got this appetite seemingly to return to work. What's the environment like in your Central European operations comparatively?
Well, the big driver for Central European interest at the moment is the fact that there's a massive difference between interest rates in Poland, for example, and in the Eurozone. And that's been a driver, as you probably know, for the last 12 years, ever since the last credit crunch. The carry trade, which is how it's known, borrowing in cheap currencies and investing in slightly higher returning currencies, has been a thing, and it continues to be a thing as far as Poland is concerned, because it's a relatively safe environment in which to invest. It's a much faster growing economy and it has higher interest rates. So I think the investment landscape for Poland is set fair. The same applies to Romania, but it hasn't got the depth and breadth of capital market that Poland has, so it doesn't attract as much international investment. And that's really the problem for the UK. The question for the UK is, why would you buy here over a faster growing economy like Poland? And I imagine that the deals that we do, we will do deals in the UK. We're opportunistically driven and there will be deals to be done in the UK. But, we're much more excited, as we have been for the last 15 years, about Poland.
What do you perceive as the risks from here? I ask this in the context of the inflation numbers that seem to be building, certainly here in the UK. And I know that some people are pricing in possibly something like around about 100 basis points of interest rate rises to come over the next 12 months, possibly from the Bank of England, depending on the expectation that inflation continues to build. What are your thoughts in terms of the outlook?
Well, it's very interesting, isn't it, that we've come through these COVID lockdowns and there have been a number of unintended consequences, one of which has been the breakdown of supply chains, so that when the demand tap was switched back on, supply chains simply couldn't cope when we've had this spike in inflation. It remains to be seen, I think, whether the spike is endemic and will stay with us or whether it's a one-off adjustment to the world reopening up. It seems to be, from what I'm reading, that it's more the former, that we're going to have to get used to inflation at a higher level, perhaps for a protracted period. But I think the dilemma the Bank of England's got is that the government is so highly indebted, and even the private sector now, in order to survive lockdowns, has had to take on quite a significant amount of debt. There's a question mark, I think, over how much they could really raise interest rates without damaging the British economy even further. So I suspect interest rates won't go up that much. Even 100 basis points, by the way, is not really a massive increase when you think about where interest used to be, 20 years ago. Even with a 100 basis point increase, you're still looking at very low interest rates. So I think this carry trade, this borrowing in cheap currencies, investing in slightly more expensive ones, will continue. And I suspect that the UK will see continued low interest rates, even if they do raise interest rates a little bit. And I also think, you didn't ask this question, but I think we will also see continued pressure on sterling.
How does that play out on a company that you report in sterling, but you do have these other currency exposures because of your exposure to these other markets? How do you see that playing out then?
Well, if sterling does come under pressure because it suffers greater inflation, can't raise interest rates the way it needs to in order to combat that inflation, and doesn't have the growth rates to justify the inflation, if that happens, and that's what I suspect will happen in the UK, then sterling will weaken. And of course, our Polish zloty and euro-denominated investments will go up relatively in value. And we will see greater profits coming out of First Property Group in sterling terms.
One of the things I said, of course, at the top is, and I think this is significant as to why I said it, the fact that you've cut the company's net debt by a third, and clearly going into an environment where we do see higher interest rates, that is clearly something that the board ought to be looking at, obviously. But nonetheless, you've still got £12 million, I believe, in cash on the balance sheet. What are you going to be doing with this? What are your plans for that? And do you anticipate paying down more debt? Or do you think you're at a debt level now which is good for a business like you?
Well, I'm a believer in buying property financed in part by debt. If you can make that equation work, you're using other people's money to bolster your returns. What's there not to like about that as a matter of principle? So, I'm a believer in using debt to buy property, and we always have done that, and we will continue to do so. Actually, our gearing levels are lower now than they've ever been. And probably you're going to see us investing that 12 million in cash, allied either with third-party investors as well, but certainly looking to borrow against that money to drive rates of return up. As I mentioned, interest rates are at all-time lows still. And even if they go up a little bit, they're going to be very low. So if you can buy property on half-decent yield and you can gear up against it, you're able to magnify returns quite considerably. And it's a simple financial engineering task, but it is one that can be very remunerative. So we will be looking at that. But in terms of how we use that 12 million, Jeremy, we're going to be trading property, I think, much more actively than we have been in the past. There is this disconnect between the occupational markets and the investment markets, and that does create trading opportunities, and we'll be looking at that much more closely.
What do you think in terms of moving into other areas within the property market? I think you've said that you are in commercial property. Is there any appetite, do you think, at all from your view of the world to get into residential, or is that something which you're never going to touch?
We're not going to get into residential investment. That's really not going to be for us. It's too granular a trade. We're too small a company with too few human resources to manage that kind of portfolio. But what we have done in the past, and will certainly do in the future if the opportunities arise, is to buy office blocks or retail properties that lend themselves to residential conversion, or indeed industrial, which lends itself to residential conversion, and make money if that conversion yields a better return than sticking with the existing use class.
What is your client base like at the moment in terms of occupancy? What do you tend to go for?
Well, typically we are in offices. The majority of First Property Group's investments are offices. And typically we buy well-located property, but secondary buildings. So it's not Class A stuff. We buy sort of Class B buildings in prime locations, or as near to prime as we can. And the nature of our occupants are therefore small to medium-sized businesses, government agencies, who are looking to be as central as possible, but don't want to pay the very big rents that the large occupiers pay. And actually, that's been a huge benefit for us throughout our history, because we've had effectively securitized income through multiplicity of tenancies in these various buildings. We've never, we have on occasion had larger tenants than others and been more dependent on them staying in order for us to make the returns we wish to make. But on the whole, our portfolio has been quite securitized through the multiplicity of occupants.
Let me bring up a share price chart just to remind ourselves as to where we are. I said it again at the top that the share price has recovered considerably. In fact, I think 34, 35 pence a share now, levels that we've not seen since June this year. So much of that, of course, coming through today. We got this good number coming through this morning, and quite clearly investors happy with what where the share price is. How would you appraise what it is where the share price is, your market cap, compared to the assets you have, and how you expect those assets to perform? I guess part of this is also about the potential for bad debt amongst the occupants if companies don't recover from COVID as we hope they might do.
I mean, actually, we've had a fantastic collection rate on rents throughout the COVID lockdown. Even at its worst, we were collecting over 90% of all rents due to us. So I don't see rent collection as a problem. You know, we've seen how governments have reacted to the pandemic and the lockdowns that they instituted, which is effectively to print money. So the economy's been awash with money, continues to be awash with money. And I suspect that collection of rents isn't going to be the big problem. As far as our share price is concerned, we are, I think, and I'm not saying this because I'm CEO and a shareholder of First Property Group, I'm saying it because I genuinely believe this. I think we are seriously undervalued. Our net asset value per share is about 48 pence a share. 11 pence of that is in cash. The rest of it is in assets. And this is at a time that after we've been through 18 months of lockdown with asset values being hit quite hard over the last 18 months. So I think we're going to see a recovery in asset values going forward with these strong investment markets that I've already mentioned. And we're going to be deploying that cash that I mentioned. So the 48 pence a share NAV that we've got, I think, is likely to rise of its own volition over the next few months, year. And we're already at a massive discount to the 48 pence a share. So I think, for what it's worth, I don't know if I'm allowed to say this, but I think it's, you'd be hard pushed to find a better home for your money than First.
Well, of course, as chief executive, of course, I invite you to say whatever you like. But of course, it does resonate, I know, with some shareholders when looking at this. And I think if we go back to the chart, just wanted to highlight where that NAV is compared to where we are in terms of the share price. You can see if I draw that line across there, and that takes us up to levels not seen since the 2nd of January 2020. So you can see potentially, Ben, yes, indeed, if you use that NAV as a guide price, you've got some upside potential to go. Let me just, as a final point here, if I can, take a look at where we go from here. You've highlighted a little bit more about what your intentions are. We're now already in the in this second half. How has the second half started, and what is the trajectory, do you think, going into the back end of this full year that we're in at the moment?
Second half has started very well. We've just restructured a fund that was coming up for the end of its life in February 2022. We've extended the life of that fund until 2027. We, First Property Group, have invested another 3 million in it. It's called UK PPP. You can look it up in our interims. And I think we've invested that 3 million at a time when, as I say, property values have been quite low. So I expect to make good money out of UK PPP, both for its shareholders as well as First Property Group as we go forward. We've also launched a new fund called FPROP Fulcrum, which should grow to about 100 million. We've only deployed 10 million of it so far, but should grow to about 100 million over the next year or two. And we've also targeting a number of specific investments, which I think would be very significant for the group if we can pull them off. So I'm really quite excited about the next 6 months to a year. And the challenge for us, as I've said at the beginning, I'll repeat, the challenge for us is just leasing up the vacant space we've got for the occupational market to recover, which would be terrific. And in the meantime, for us to take advantage of the arbitrage that's available between the occupational market and the investment market. So you will see us trading property more actively over the next 6 to 12 months. And that too, as a property man, is exciting because, there's nothing you never enjoy your beer more in the evening than after you've done a deal.
I agree with you on that. Doing a deal is, and in your favourite, is always a very happy day to end a day, I should say. Look, Ben, we'll have to leave it, but thanks indeed for joining us. Ben Habib is Chief Executive of First Property Group, reporting earnings today. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.